Hello everyone and welcome to another episode of Deloitte Let's Talk. And today we're going to go through some of the changes in the Budget Act that could be impacting your personal income tax filings. So there were two major changes that resulted from the recent amendments. The first one concerns overtime work. So under the previous legislation, there was no distinction at law made between any work or any income you derive during your regular 40-hour week versus anything which you may have earned as a result of your overtime work. Now, in last year's budget speech, the Minister for Finance announced a new special regime with a flat tax rate of 15% applicable on the first 100 hours of overtime work performed by qualifying employees. Now, in order to be eligible for this regime, employees must, first of all, not be in a managerial position, and second of all, they must not earn more than €20,000 in a calendar year. Now, this represents a huge potential benefit for certain employees, as things currently stand, every euro earned over €14,500 is taxed at a rate of 25%. And this therefore represents a potential 10 percentage point saving for any qualifying income which falls within this bracket. We're still waiting for some more detail around eligibility requirements to be published by the Inland Revenue. And we expect that this additional guidance is also going to cover things such as the manner in which this overtime work is to be reported, how one can apply for the election in order to apply this regime, and of course the manner in which such tax is to be collected and paid to the Inland Revenue authorities. Now we move on to the second change, and this impacts the tax filing situation of married couples. So under the existing law, married couples, and that includes partners in a civil partnership, are required to file a joint annual income tax statement. And they are jointly answerable for anything that goes into that statement. Now, married couples then had one of two choices. The first one, which is known as the married rates, is a system whereby both spouses simply aggregate all the income that they earn into a single pot, and special tax brackets are applied to that single pot. Now, the tax brackets in this case tend to be a little bit wider, and therefore this regime made the most sense in those cases where there's only one income earning spouse. The second regime, which is known as a separate computation system, is a little bit more complicated but could make a little bit more sense depending on the circumstances. So what would happen effectively is that the lower income earning spouse would be entitled to separately compute any income earned from either employment, trade, or pensions, and apply the single rates to that income. Any other income that would be earned by that spouse would be aggregated with the income of the higher income earning spouse, and the higher income earning spouse would also apply the single rates to that cumulative income. Now, the benefit over here is that because both spouses are applying the single rates to each column of income that they derive or deemed to derive separately, and therefore the tax exempt bracket on the first €9,100 would apply to each of the two spouses separately, as opposed to a single tax exempt bracket of €12,700 under the married rates. And therefore this system tends to make a little bit more sense where the income earning disparity between the two spouses is a little bit less. Now, in the Budget Act, a third new option is being afforded to spouses, and that is what is being referred to as the separate return election. Now, this effectively means that spouses can file separate tax returns completely independently from one another, and that they can report in such tax returns all the income that they would have earned separately, applying the single rates to all categories of income derived by that spouse, as opposed to only certain classes of income under the separate computation regime. Now, when would this make more sense? Well, clearly it's a slightly easier regime, computationally speaking, for those who want to preserve the benefits of the separate computation regime without having the added complexities around what income goes where and who it should be attributed to. But it also would seem to make a little bit more sense where spouses are carrying on independent business ventures and they don't necessarily want to blend or mix up any potential tax obligations that they would need to be adhering to. This is a beneficial system, but it also comes with a little bit of a catch, and that string is more burdensome reporting requirements, and therefore individual spouses need to be a little bit more diligent when preparing their records in order to demonstrate that they indeed are entitled to claim any tax attributes such as tax deductions, losses carried forward, or capital allowances, and that those attributes in fact pertain to them and not to their other spouse. So record keeping is going to be a very important factor at play. Who is eligible for this particular regime? Well, the law at the moment outlines two categories. The first would be where in any instance that both spouses earn either trading or employment income, and the second one is an instance where the spouses would have opted to apply not the community of acquis, which is the default regime, but on the other hand either the Corsa regime or the separation of estates regime to their matrimonial property. And of course, as was the case with overtime work, we're still waiting for a little bit more detail from the Inland Revenue around how elections are to be made, within which time frame, and the manner in which the returns are eventually going to be looking like. Well, thank you for tuning in today. We hope that this was informative and helpful, and we welcome you to joining us again on a future episode of Deloitte Let's Talk. Have a great day.